The stock market was hit with a wave of uncertainty as President Trump announced sweeping new tariffs. The Dow Jones Industrial Average, a key indicator of market health, plummeted over 1,000 points. This sharp decline reflects the growing fear among investors about the potential impact of a global trade war. The tariffs, targeting goods from China and other countries, have sent shockwaves through global markets. Businesses and consumers alike are bracing for the impact of higher prices. The tariffs are expected to increase the cost of imported goods, potentially leading to inflation. This uncertainty has led to a flight to safety, with investors pulling out of stocks and seeking refuge in less risky assets. The S&P 500, a broader measure of the market, also took a significant hit, falling over 4% in a single day. This decline pushed the index into correction territory, marking a drop of more than 10% from its recent high. This correction is a clear sign that investors are reassessing their outlook for the market. The tech-heavy Nasdaq Composite experienced an even steeper decline, plummeting over 6%. This decline was fueled by concerns that the tariffs could disrupt global supply chains and hurt the profits of tech giants that rely heavily on international trade. The market volatility underscores the significant impact of trade tensions on investor sentiment. The so-called Magnificent Seven, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and Nvidia have been among the hardest hit. These tech giants, which have driven much of the market's gains in recent years, are now facing increased scrutiny. Investors are concerned that the tariffs could crimp their profits and slow down their growth. Apple, for instance, relies heavily on China for manufacturing its iPhones. Any disruption to its supply chain could have a significant impact on its bottom line. The sell-off in tech stocks is a reminder that even the market's darlings are not immune to geopolitical risks. In times of market turmoil, investors often turn to defensive sectors, such as consumer staples and utilities. These sectors tend to be less sensitive to economic downturns. Consumer staples companies which produce essential goods like food and beverages are likely to see steady demand even in a recession. Utilities, with their regulated businesses and stable earnings, are also seen as safe havens. The current market volatility underscores the importance of a diversified portfolio. Investors should consider spreading their bets across different sectors and asset classes to mitigate risk. While the future remains uncertain, staying informed and sticking to a long-term investment plan is crucial for navigating market turbulence.